I see it all the time. Self-employed person who just opened up a business and already elected S Corp status or is about to, and they don't know what they're getting themselves into. Now, sometimes it's the exact right move, but sometimes they just paid $2,000 or $3,000 a year to save 200 or 300 a year, and they're drawing unnecessary attention from the IRS in the process. See, the S Corp is one of those strategies that gets talked about all over social media, like it's a no-brainer, because the content is almost always written by someone who wants to sell you on running your S Corp for you. So in this video, I'm going to give you the actual truth, when it makes sense, when it might be overdone, and what income level you should start thinking about it and having the conversation. Might save you from making an expensive mistake, and if it's still the right move, it'll at least give you a heads up on how to make it work right and stay compliant. I'm Jeff McDermott, a certified financial planner and founder of Create Wealth Financial Planning, and I'm here to make these complicated financial topics easy to understand so you can make better decisions, ideally with a professional helping you execute them right. So let's get into S Corps. Now, before we talk about whether an S Corp is right for you, you need to understand the actual mechanism, because the tax savings will make more sense once you see how the math works. If you're a sole proprietor or single member LLC taxed as a sole proprietorship, every dollar of net income you make gets hit with self-employment tax, 15.3% on top of your income tax, up to the Social Security wage base, and still another 2.9% above that. And when you work a W-2 job for another company, you pay half of that through payroll tax and your employer pays half. But when you're self-employed, you are responsible for paying all of it. An S Corp changes that split though. When you elect S Corp status, you become an employee of your own company. Your income now has two buckets. W-2 salary that you pay yourself, which you still have to pay those payroll taxes on, but you also have your remaining net income or profit that flows to you as a shareholder, which only gets taxed as regular income. No self-employment tax, no payroll tax on that net income. So you reduce the amount of income that the business is subject to paying that 15.3% additional tax on. So let's consider an example. Let's picture a consultant, we'll call him Mark. He nets $150,000 a year from his business, and as a sole proprietor, about $21,000 of that is going to disappear to self-employment tax. Some wonky math, you don't just multiply it out. But anyways, after income taxes, Mark's got about $112,500 left over for himself. So next year, Mark decides to make an S Corp election. He gives himself a reasonable salary of $75,000, and he takes another $75,000 as a distribution. Now his payroll tax bill drops to around $11,500, and after income tax, he's got about $117,500, or an extra $5,000 potentially in his pocket. That's real money, and it's exactly why everyone on the internet is telling you you've got to get an S Corp right now. But here's what those posts leave out. See, an S Corp is not a free optimization. It's a whole new layer of complexity, and that layer costs you money every single year that you have your S Corp. When you run an S Corp, you need payroll. You can't just pay yourself like you used to. You need a payroll service with those quarterly tax filings, W-2s at year end, the whole shebang. Assume it will cost at least $500 to $1,200 a year just for your payroll. Then your tax return gets a little more complicated, because it's not just a personal return, you now must file a separate corporate return, Form 1120S, on top of your personal return. And a CPA is probably going to charge between $800 and $2,000 a year for that return alone. Add cleaner bookkeeping that you're going to make sure you have, potential state and local taxes and fees, and you're looking at an annual overhead cost of somewhere between $2,000 and $5,000 or more to maintain your S Corp, depending on where you live and who you have working with you. California is a great example. The state charges an $800 minimum franchise tax, plus other potential taxes for S Corps, which can seriously eat into what you thought you were saving in taxes. And there's a couple more twists buried in the tax return that will cost you money. See, you might have noticed that S Corp Mark owed less payroll tax, but owed more in income tax. That's because you lose the ability to deduct half self-employment taxes, because there were no self-employment taxes, and your qualified business income or QBI deduction is reduced because a chunk of that business income shifted over to salary. It's a big topic that would have its own video if you're wondering what I'm talking about there. The point is, there's lots of hidden costs that a crude payroll tax comparison would miss. So let's go back to Mark. His tax savings look like they were around $5,000. If it costs him $3,000 to maintain the S Corp, and he nets around $2,000 after the election, Mark needs to decide, is $2,000 worth the hassle? Is there additional risk that the S Corp is bringing in? Or does he want to go ahead and hope that his income will continue to go up and make it worth it in the future? So you're probably asking, why doesn't Mark just cut his salary further to save more on taxes? And this part trips a lot of people up. See, the IRS doesn't just let you pay yourself $1 in salary and take everything else as a distribution. They require what they call reasonable compensation, which means you have to pay yourself what you would pay someone else to do your job in your industry, in your location, for the hours you work. There's no specific guidance on it. Just pay yourself something reasonable. So if you were thinking, Jeff, can't I just set my salary low and maximize the distribution? The IRS is on to you. The answer is no. If you pay someone else $90,000 to do what you do full time, and you only pay yourself $35,000 because it sounds better on a tax return, that could be an audit risk. And if the IRS caught up with you, you'd have to reclassify those distributions as wages. You could get hit with back taxes, penalties, and interest. Setting the salary correctly does take some effort. You've got Bureau of Labor Statistics data that you could use, documented job descriptions, time allocation. It's all got to add up and come together if someone asks questions. Your payroll provider might also have a reasonable wage calculator where you can plug in your job details. The bottom line is, it's not just a number you make up because it sounds good. It's got to be a number that makes sense. Remember too, the S Corp now only saves you money on the income above your reasonable salary. So if your reasonable salary is almost your entire net profit, the savings will be very small. Here's another quick point about the S Corp salary that often gets overlooked. That's the number that gets reported to the Social Security Administration to calculate your future Social Security benefit. So I meet business owners all the time, can't figure out why their Social Security benefit is so small and it's weighing on their retirement plan. And it's because they paid themselves peanuts under the S Corp. If you were going to pay less into Social Security, you'd better be investing some of that savings to build your nest egg to compensate. So with all that as context, the picture starts to get a little more clear. Now, I don't want to get too specific with numbers. Probably wouldn't even think about an S Corp though if my net business profit wasn't consistently and comfortably clearing $75,000 to $100,000 a year or more. You might need more, depending on what your needs for your reasonable salary are, to ensure there's a good gap and there's room for some meaningful tax savings. And you've got to be genuinely committed to the ongoing compliance and doing things right. Good payroll, clean books, good accountant to work with, all of it. At $100,000 in profit with a documented $55,000 salary, you might net a couple thousand in annual savings after the overhead. Useful, but not life-changing. Could even put you at a loss if with that reduced Social Security benefit. At $150,000 profit, it starts to climb to maybe a few thousand or more per year, which is more useful. That could be an annual Roth IRA contribution right there. And as that net income goes to $200,000 and above, an S Corp is definitely a serious conversation worth having with your CPA and financial planner. One more thing worth calling out though, the savings only exist on the income up to the Social Security wage base. In 2026, that amount is $184,500, usually goes up a little bit every year. And above that threshold, you'd only owe the 2.9% Medicare portion anyway. So the benefit narrows considerably at those higher income levels. The sweet spot is probably in that $100,000 to $300,000 net profit range for most self-employed people. If your profit's in that zone and your work is a primary revenue driver, the math is probably in your favor, but you still need to have your accountant do a real calculation with actual numbers, not just a back of the envelope estimate. Everything that'll change your tax return, all the costs associated with it, have them prove to you that you'll come out ahead before you make a change with the IRS. So as we've talked about, it's easy to put the cart before the horse with an S Corp election. One of the worst things I hear is, I just set up my LLC and I went ahead and did my S Corp from a brand new business owner. An S Corp's probably overdone right there, or at least premature, when you're just starting out or when your net profit is usually below that $75,000 plus number, because the compliance costs will almost certainly wipe out most or all of the tax savings, and your ability to pay a reasonable wage is going to be very limited with that limited income too. I run into folks sometimes not paying a wage at all, which is a huge red flag. If your income's inconsistent or seasonal, it could also mean trouble, since running payroll and maintaining corporate formalities in a business that has a bad year or widely variable income could create more headaches with very little upside. And remember, if it's a side hustle and you already have a W-2 day job, that full-time salary is probably covering a lot of those Social Security payroll taxes, meaning that self-employed tax savings on a little side income are also way thinner than the math might suggest. If you have big plans for your business, there's also some flexibility cost that you might not be thinking about. An S Corp has real restrictions that could impact future growth. No more than 100 shareholders, all must be U.S. citizens or residents, only one share class of stock. If you ever want to bring in outside investors, add foreign partners, set up more complex ownership structure, an S Corp could box you in. It's a great structure for simple, profitable, owner-operated business, but it can be less great if you're thinking about evolving into something bigger. The people that usually get burned by S Corps are the ones who read a blog post or saw something online, filed the election themselves, set a token salary, and then discovered years later they didn't do the compliance right. But I also see some accountants that I think push S Corp elections way too early, so ask them to do the math and prove the recommendation first. So to bring it all together, the S Corp's a legitimate, Powerful tax tool when you have strong, consistent net profit and when your reasonable salary leaves room for meaningful net income to save self-employment taxes on, and when you're committed to the compliance it requires. Too little income or without the right professional support, it's often overdone and it can cost you more than it saves. If you are a self-employed person wondering whether an S Corp is the right move for your situation, that's the kind of question we dig into around here. So reach out through the link in the description and book a free intro call with me at Great Wealth Financial Planning. Or if you know another business owner who's on the fence about this, share this video with them. It might save them a few $1,000s and probably save them a lot of headache.